This course is based around the philosophy of naked forex. This is a concept that I picked up in a book of Walter Peters called Naked Forex. Basically what he says is that trading without technical indicators is better. Technical indicators are lagging. They are based on old information. So by the time they give a good buy or sell signal, it's mostly too late. The philosophy of naked forex lies close to price action. Basically, you only look at how the charts are evolving, how they previously were, to anticipate with a high probability the next move. So what are indicators? An indicator is a visual aid that is added to the price chart. For instance, a moving average or a Bollinger Band. As you can see, they clutter the graph quite a lot. And as we discussed before, it is based on old information. So the philosophy to trade naked is to remove all indicators and solely depend on how the candlesticks are evolving. Before we go into depth about programming, trade setups, etc., let's recap some of the fundamentals of Forex. In the Forex market you can buy and sell currencies. This always goes into pairs, for instance the Euro-US dollar pair. As we can see in the price chart, we can buy 1 euro at the current market price of $1.26. And the chart you see consists of candlesticks. Every bar that you see here we will call a candlestick. And a candlestick is the price movement of a certain time frame. We can trade on a 5-minute chart, we can trade on a 1-hour chart, daily chart, monthly chart, or even yearly chart. Right now we're looking at a 4-hour chart. That means that at, for instance, 12 o'clock the price opened right here. Then during these 4 hours of trading, the price moved up to a high, a low, and closed right here. And then continued trading the next time frame here. We have to remember that there are two types of bars. You have a bullish bar. A bullish bar is when the closing price lies higher than the opening price, hence it's in an upwards momentum. A bearish bar is when the bar is closing below the opening price, as we saw here. The closing price is below the opening price and it's going down. The change of the price during trading is expressed in pips, and pips are the smallest movement a currency can make. In this example, 1 pip refers to 0.001. Looking at this decimal right here. That's for the basics about candlesticks. Let's look at how to make orders. When we are making an order, we first have to define the type of order. We can buy a currency or sell a currency. For instance, we would buy the currency right here, wait until it moves up and sell it right here, or the other way around. We start selling the currency here, wait until it moves down and sell it right here. With this you can make money in both directions. When looking at when the order is executed, we have two types of orders. We have a market order and a limit order. A market order is when the price is executed at the current market price, as we see right here. We can also ask for a limit order. Then we define a price at which we want the order to be executed. For instance, imagine that we're currently trading right here. We see that the market is moving down, but we're not sure it maybe moves up again. So we place a limit order to sell just below the closing price, for instance right here. Then if the market moves up, nope, nothing happens. But when the price moves down, it will get triggered here and our order will be executed and we will sell the asset. An order has three important aspects. The first one is the entry price. When we want to place an order, we have to define at which price we want to buy or sell the asset. For instance, right here. In this case, we want to buy the asset. Then we have to define a take profit, at which price we want to sell the asset again, and we take our profit. In this case, we would imagine that we want to put the trade profit at this level. This means that when our order is executed at this point, and it moves up, it's automatically sold again at this point, and we will lock in this profit. To protect ourselves from changes in the other direction, we can also define a stop loss. For instance, at this level. If the asset were to move down in this direction, it will be automatically sold at this level, and we will be making a small loss, but we will protect ourselves from further losses. These are the fundamentals of orders. Please make sure that you are acquainted with the basics of trading before you proceed. With this, we come to the end of this video. See you in the next one.